The ICF Training and Technical Assistance Team is honored to welcome you to this California Housing and Community Development training session offered through the Emergency Solutions Grant, Coronavirus Relief Consulting and Staffing Services Contract. I'm Chris Pitcher from ICF, and I'll be hosting today's session. Today's training session is entitled Grant Management Principles, and it is my privilege to introduce today's presenters, Rudy Munoz and Nora Lally. I'll first hand it to Rudy.
Thank you, Chris. It's an honor and a privilege to be with you today to provide you with this grants management principles training as part of the ESGCV training series. Today's session will be a high-level overview of grants management. So I encourage you to put on your seatbelts as we'll be flying at around 25,000 foot level for this training. In today's training session, we'll look at grants management from the perspective of both the Emergency Solutions Grant, or ESG, and the Emergency Solutions Grant under the CARES Act, or ESGCV. As a quick note, you've probably started seeing on this slide, HUD tends to use acronyms within their programs, and the ESG grant is no exception. So during the training session, we will try our best to use the full title for any acronym that we will use for the first time, such as using the term Emergency Solutions Grant when we talk about ESG. During this training, Nora and I will be focusing on some of the most common aspects of grants management. In some cases, we'll describe aspects that are applicable to all of HUD's grants. Examples would be Section 3 or procurement, right? Applies to all of HUD grants. In other cases, we'll describe aspects that are unique to the ESG or ESGCV programs, such as expenditure deadlines or data collection and data entry into the Homeless Management Information System, or what is commonly referred to as HMIS. So let's go ahead and get started with the training session. As you may already be aware, the state of California, as the recipient of the ESG and ESGCV grant funds, has designated the Department of Housing and Community Development, or HCD, as the agency that is responsible for the administration and the oversight of these grant funds. As part of HCD's responsibility for the administration of the ESG and ESGCV programs, and in compliance with the federal regulations, HCD has developed policies and procedures on a wide range of topics, and these are required by the ESGCV grant agreement that was entered into by the state of California and HUD. These policies and procedures include program-specific topics to address the requirements of 24 CFR Part 576, which are the ESG requirements, as well as any corresponding cross-cutting topics such as procurement or Section 3. The topics also address specific conditions for compliance that are specified in the grant agreement between HUD and the state of California, as well as the requirements contained within the Federal Register notices. These would represent additional layers to the foundational ESG regulations that we find in 24 CFR Part 576. In accordance with these requirements, HCD, as well as all of the other grantees and subrecipients that are receiving the grant funds from the state, are required to prepare, adopt, and implement policies and procedures as a condition of receiving the grant award. Next slide. So part of grants management is establishing roles and responsibilities that are associated with the grant and ensuring that all participants in the implementation of the grant are aware of their specific roles and their specific responsibilities. On this slide, we can see 4 different tiers or horizontal bars, with each of them representing a participating entity in the ESG or ESGCV program. And they are HUD and the Office of the Inspector General, or OIG. And this entity is considered the federal awarding agency. Funds are awarded by HUD to the state of California, which is the next tier, the Department of Housing and Community Development, or HCD. HCD is considered the recipient of the ESG and ESGCV grant funds. You have at the next level, the grantees or the community of care, continuum of care, COC entities below HCD. And they are the entity that receives the funds from the state, from HCD, who is a pass-through entity. And then at the bottom, you have the subrecipients, who in some cases may be the same as the grantee, or in some cases is the entity being funded by the grantee. In general, all of them, the grantee and the subrecipient are treated similar to HCD in that their responsibility and the requirements that they must follow are all the same. They mirror each other. There's oversight requirements, and we'll talk about that a little further in this slide. Each of the parties in the 4 tiers has a responsibility for the oversight of the grant funds and the responsibility to ensure that the entity below them is implementing the program correctly. Each entity in this diagram, with the exception of the subrecipient, is responsible for the monitoring, for the oversight of the entity that they awarded grant funds to. So if we look at this graphic, HUD awarded the funds to HCD, HCD awarded the funds to the grantee awarded the funds to the subrecipient. Okay. So again, each is responsible for ensuring that the tier below them is implementing the program correctly, and they do so by monitoring those agencies and ensuring that they are overseeing the activities of that entity. As an example, again, it's the responsibility of HUD and OIG to monitor and provide the oversight of HCD. At some point, HUD or OIG or OIG may be coming out to monitor HCD. It's also then the responsibility of the HCD staff to monitor and provide oversight of the grantees that it funds, as well as conducting internal monitoring, audit, and oversight of its own organization, or HCD. The responsibilities for each of the tiers includes reporting on accomplishments and reporting on expenditures. So going in the opposite direction of what we've been talking, where we have been going from top to bottom, now we're going to go from bottom to top. As an example, it's a responsibility of the subrecipient to report to the grantee, and the grantee to report to HCD, and HCD to report to HUD. The reporting should include, but not necessarily be limited to, the accomplishments for the reporting period. Note that, it's an opportunity for each level to tell their story. It's up to each entity to also review the performance by that reporting entity to ensure that the established goals are being met, and that there's a relationship between the accomplishments that have been met and the expenditures. The scope of work is generally included in your agreements, and that should also include performance standards and possibly interim milestones, as well as the documentation and reporting requirements. So when planning, also consider how you will evaluate these performance reports. Okay. Nora, I will now hand it off to you.
Thanks very much, Rudy. Hi, I'm Nora Lally, also excited to be part of the team here today to talk about these grant management requirements that often sound scary or overwhelming, but really sometimes are more just a process of formalizing what you are already doing. One example of that is the ESG requirements to have written standards. So what written standards are really a series of answers to questions about how you're going to operationalize and run the ESG programs within the community. And the fact that they're written just means that you've made decisions about how the resources are going to be used, and then you've written them down so that they can be referred to, they can be referenced over time. It also means that they can be changed and adjusted as needed. So what we have seen with the ESG CV funds in response to COVID-19 is the idea that communities need to change their written standards in order to really reflect the crisis response of the resource. So some of the standard elements of written standards are specified by HUD, the certain things that a community has to decide about how it's going to use this resource, but it really is up to either the recipients or then passed through in that flow that Rudy described to be able to make decisions about certain operational elements of the ESG funding by answering questions like, how are we going to determine who's eligible to receive the funds, either through, and to be able to use funds at the person level, how are we going to determine eligibility for street outreach? What kinds of services are we going to use? How are we going to allocate resources for emergency shelter and prioritize essential services? How are we going to operationalize admission, diversion, referral, and discharge at emergency shelters? And how are we going to meet safety and shelter needs of victims of violence and those who have the highest barriers to housing at our shelters? How are we going to prioritize who and how and what kinds of essential services we're going to provide at those emergency shelters? There's also a series of questions about homelessness prevention and rapid rehousing. How are those resources going to be prioritized? How are we going to determine what the program will pay for rent versus and utilities versus what participants will pay? And how will we determine how long participants will receive the assistance and whether or not that assistance will be adjusted over time? And also, what kinds of services, housing stabilization and relocation services, will we provide? How will we meet our VAWA, Emergency Violence Against Women Act, not to throw in another acronym there. How will we meet the VAWA Emergency Transfer Plan requirements? And how are we going to ensure participation in the Homeless Management Information System? So those are the standard written agreements that recipients and subrecipients have had since they've had Emergency Solutions Grant funding. But with the ESG CV funds, there was some opportunity, as I've referenced before, to be able to make some adjustments to those decisions that had been made prior to COVID. And when those adjustments are made, it's just important to update the written standards, which essentially become the playbook for ESG. You want to always make sure people are operating off the most recent playbook. So if you made any adjustments to how resources would be prioritized based on COVID response, you would update your written standards. If you used ESG funds for temporary emergency shelter and wrote and determined protocols for the use of those, you would update your written standards to include that information. If you made adjustments to your coordinated entry prioritization, that's also another decision that you just would want to make sure your written standards are a living, breathing document so that everyone who manages the funds as well as accesses the funds has the most up-to-date information about how those funds are being utilized. These slides will be available after the presentation with live links. So there's a linked document in here that has some tools from HUD about language and other adjustments to written standards that can be used for COVID response. Expenditure deadlines are also another element that have always been a part of the Emergency Solutions Grant funding. So there's nothing new for ESG CV other than that the expenditure deadline is consistent across the country. The ESG CV funds expire on September 30th, 2022. So all costs, eligible expenses must be incurred prior to September 30th, 2022. And within your written agreements, there are some smaller target deadlines to be able to ensure that that September 30th, 2022 expenditure deadline is met. A few of them have already occurred. There was a July 31st, 2021 deadline, a September 30th that just passed, soon to be a November 30th target deadline to be at about 60% of expenditures, and then an 80% expenditure deadline by the end of January next year. So these targets reflect HUD's targets in order to make sure that the money is actually being expended. Since it is a crisis response resource, it's meant to get the money quickly out into the community, into people's hands. So those expenditure deadlines are how HUD operationalizes the idea of a quick turnaround and a quick spend down for those funds. And I think we're back to Rudy now.
Thank you. So in this next slide, we will financial management. As the slide indicates, financial management is the process for using funds effectively, efficiently, and transparently. Effective financial management is the heart of ESG and ESG CV administration. To comply with the regulations, HCD and its grantees or subrecipients must have financial management systems in place that provide an accurate, current, and a complete disclosure of the financial status for each grant activity. And this is in accordance with the terms and conditions of the grant agreements. Accounting records should show the source and application of these ESG and ESGCV grant funds. The records maintained must disclose accurate information about grant and sub-grant awards, about obligations, unobligated balances, should disclose information on liabilities and expenditures. The financial management systems for HCD and its grantees and subrecipients must have a budget control system that makes it possible to compare actual expenditures with budgeted amounts for each of the funded activities. The financial management system must make it possible to relate financial information to performance or productivity. It must also have sound internal control procedures that cover cash, real estate, real and personal property, as well as other types of assets. The underlying financial management regulations that must be followed by HCD, the grantees, and the subrecipients is found in 2 CFR Part 200. So we are always talking about 2 CFR Part 200 when we're talking about financial management and some other elements that are incorporated into 2 CFR Part 200. This is also known as the Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards. The 2 CFR Part 200 requirements can be separated into 3 distinct buckets. And those 3 buckets are the administrative requirements, which are found in subpart A through D, the cost principles, which are found in subpart E, and the audit principles, which are found in subpart F. So I'll talk about each of these different buckets and what it covers. The administrative requirements section covers things such as budgeting, financial management, such as accounting records and systems. It covers internal controls. It also covers procurement. Procurement is under 2 CFR Part 200, and we'll talk about procurement in the next slide. And it covers other elements of other administrative requirements. The cost principle section covers things such as allowable and unallowable costs. It also covers direct and indirect costs. And these are subjects that quite often require additional information or clarification on what may be a direct and what may be an indirect cost. And it's a subject that is difficult to explain sometimes because an indirect cost, a cost can be indirect for one situation, but a direct cost for another. So those elements are contained within the cost principles section. The audit requirements section covers the single audit requirements. And so currently, any grantee, any subrecipient that receives more than $750,000 in federal funds during a program year must undergo a single audit. Move on to the next slide. So the Department of Housing and Community Development, as the recipient of the ESG and the ESG-CV funds, must follow the procurement requirements that are outlined in 2 CFR Part 200. More specifically for HCD, they must follow sections 200.317 and certain sections of 200.318 through 327. The regulations do not require that HCD competitively procure for the services of grantees or subrecipients. The regulations allow them to be treated as the definition of subrecipients through a subaward. Instead, for those that are considered subrecipients under the definition of 2 CFR Part 200, the procurement requirements are passed on to them. So grantees and subrecipients must now follow the requirements that are outlined in 2 CFR Part 200 that range from 318 through 327. As a result, grantees and subrecipients must also adopt written procurement procedures, just like HCD has to adopt written procurement procedures. And those procedures should ensure that you are achieving a maximum open and free competition, that they cover standards of conduct, and that it also covers small and minority business outreach. If elements of your internal policies and procedures or written standards are more restrictive, then you must follow those requirements. And as an example, in 2 CFR Part 200, it allows for a small purchase proposal to be awarded for up to $250,000. However, most grantees or subrecipients have a smaller limit within their own internal written standards or policies and procedures. So wherever they are more restrictive, you must go with the most restrictive requirement. It's important to also note that contractors and beneficiaries are not subject to the procurement requirements of 2 CFR Part 200. So as an example, if you are undertaking a facility rehab, the contractor is not required to procure for the services of a subcontractor. They can simply just hire that subcontractor of their choice. Procurement is required when you are obtaining goods and services that will be paid utilizing the ESG or the ESG-CV grant funds. Now, there are 3 major methods of procurement. The 2 most common methods are provided in this slide, and they are the informal procurement and the formal procurement methods. Note that there is a 3rd method, and it's called the non-competitive procurement method, which is not commonly used and does require specific justification and documentation for the use of that method. Within the 2 most common methods, there are 2 options under the informal procurement method, and they are the micro purchase and small purchase process. Under the micro purchase, The current micro purchase threshold is $10,000 per purchase. And this is updated periodically by the Federal Acquisition Regulation, or what is commonly referred to as the FAR. It requires that purchases be distributed equitably among qualified suppliers and that the price be reasonable. So you need to establish the list of qualified suppliers and make sure that you are going from supplier to supplier along the way, and you are tracking that you went to supplier 1 the first time, 2 the second time, 3 the third time, so on and so forth. And as you do so, that you are ensuring that the price that is being provided to you for the purchase of those goods and services is reasonable. Under small purchase, the current small purchase threshold is greater than the micro purchase, or $10,000, but no greater than the simplified acquisition threshold amount. Now, what does that mean? The simplified acquisition threshold is determined by the entity based on its internal controls and evaluation of risk, or their internal written standards, as we spoke about earlier. And so you need to make sure that you are complying with those specific thresholds. There are also 2 options under the formal procurement method, and they are the sealed bid and competitive proposal. Under sealed bids, the bids are publicly solicited, and a firm fixed price contract is awarded to the lowest responsive and responsible bidder. This is the method that is typically used for construction type procurements. Then under the competitive proposal, the bids are generally a fixed price proposal, or it could be a cost reimbursement type contract. And it is used when conditions are really not appropriate for the use of a sealed bid method. The process should include a written method for conducting evaluations of proposals and making the selection. So this is a common method when you are looking at, for example, consultants that are going to be doing specific work. The procurement process must be documented and should at minimum include the solicitation documents, offers that are received for bids that are submitted, evaluations and determinations, and advertisements for NEBI-WEBI and Section 3 if those are applicable. Next slide. Next, we'll discuss the subject of contracting. So once again, we are going to reach out to our 2 CFR Part 200 regulations when discussing contracting. Before dispersing funds to any grantee or subrecipient that is carrying out the grant activities, a written agreement or a subaward must be executed. And this starts with the subaward that is executed between HCD and the grantee or the subrecipient. And then in a similar fashion, a grantee or a subrecipient that received the ESG or ESGCV funds must execute written agreements with its consultants, its contractors, or any other parties before dispersing any funds. Every entity that is entering into an agreement for goods and services must prepare and enter into an agreement that at minimum contains language that addresses the provisions that are found in 2 CFR Part 200. And the key agreement provisions are listed in this slide. And they include environmental standards, equal opportunity, record keeping and reporting, and procurement records or requirements, just to list a few. In addition to the key agreement provisions that are listed on this slide, depending on the value of that contract, additional federal provisions may need to be included. And as an example, contracts that are in excess of $10,000 require the inclusion of a provision for termination for cause and for convenience. Refer to 2 CFR Part 200 and is specifically in Appendix 2 for additional information on the contract provisions for non-federal entity contracts. And finally, HCD as a pass-through entity must also ensure that every subaward that is issued is clearly identified to the grantee or subrecipient as a subaward. And that would include the provisions that are identified in 2 CFR Part 200, subsection 332, which is titled Requirements for Pass-Through Entities. And the provisions in that section include, but are not necessarily limited to, federal award identification number, subaward period of performance, subaward budget period, start and end dates, and there are additional requirements. So I encourage you to view that section if you know, for HCD staff. Next. So on this slide, we'll be discussing the principles of duplication of benefits, or DOB, and how to adhere to those requirements. A duplication of benefits occurs when a person, a household, or a business, even a government entity, receives financial assistance from multiple sources for the same purpose, and where the total assistance that is received for that purpose is more than the total need for assistance. The duplication of benefits requirements come from a combination of areas. They start with the Stafford Act. They come from the OMB cost principles that we have been discussing. And they come from the ESG CARES Act requirements, the Federal Register Notice. Okay? For establishing a DOB strategy and guidelines, grantees and subrecipients should become familiar with the basic steps of performing a DOB analysis. These steps should provide the foundation for the operating procedures for duplication of benefits review. And on this slide, we provide, we list 4 steps for conducting the DOB analysis, starting with step 1, which is assess need. So we look at assessing the amount of need for the total cost of that activity. Step 2, verify awards and use. So we want to determine the amount of assistance that has or will be provided from all of the sources to pay for the costs. So when you are evaluating a recipient's need, it's important to remember that a recipient may have multiple sources of assistance to address their needs. However, not all of the sources may necessarily be used for that same cost. So be sure that you are asking about the recipient's resources and how they plan to apply those resources to specific costs. I say that because you may find that resources will be applied to separate costs and not necessarily present a duplication of benefits. Step 3 is to calculate the unmet need. And this is basic math. So you want to define all activity costs and identify related sources. Ask the recipient how it proposes to apply those resources to the cost. If there is a balance of unsupported costs after applying the existing resources, then CARES Act or ESGCV funds can be invested without causing a duplication of benefits. And then step 4, document analysis. So you want to maintain adequate documentation justifying determination of maximum award. Okay? And I always say in all of our trainings that the 3 most important things when you are implementing these programs are: number 1, documentation; number 2, documentation; number 3, documentation. You can say that you implemented certain things, but unless you document, there's no way of showing that you actually completed certain tasks. And so on the upper right-hand corner, we have included a list of items that you should maintain for your files for each applicant or project that is being assisted. And these would include the DOB calculation worksheet, the award verification, and the use verification. Next slide. So the purpose of Section 3 is to ensure that employment and other economic opportunities that are generated by federal financial assistance for housing and community development programs are to the greatest extent feasible, that they are directed towards low and very low income persons, particularly those who are recipients of government assistance for housing. There have been some recent changes to Section 3. These changes took place towards the latter part of last year. The HUD final Section 3 rule became effective on November of 2020. And these changes that were made were done so to streamline the tracking and the reporting requirements. And these were done to align the regulations with the standard business practices and to improve Section 3 outcomes. Covered projects under Section 3 include public construction activity or projects that have been assisted with $200,000 or more of federally covered program funds. And this would include ESG or ESGCV funds. Section 3 applies to an entire project, regardless of whether it's fully or partially assisted with the grant funds. Once you provide a dollar of assistance, it has now infected that project and it now has to comply with the Section 3 requirements. As long as that project assistance is receiving more than $200,000 of federally covered program funds. Under the new Section 3 regulations, contractors are required to track labor hours, which is different than what we used to do before. And they must meet the following requirements that are listed on this slide. 25% of all labor hours must be worked by Section 3 workers, and 5% or more of all labor hours must be worked by targeted Section 3 workers. And so real quickly, what is considered a Section 3 worker? A Section 3 worker is a worker who is either currently or when they were hired within the past 5 years, they were a low or very low income resident, or they were employed by a Section 3 business concern, or a youth build participant. And as a follow-up, where a targeted Section 3 worker is any worker who is employed by a Section 3 business concern, or is currently, or if when hired within the past 5 years, was living within a service area or a neighborhood of the project, or again, a youth build participant. Next slide. The purpose of the environmental review process is to analyze a project and its potential environmental impacts to determine whether it complies with the National Environmental Policy Act, or NEPA, and it relates to laws and authorities. All HUD-assisted projects, and this includes ESG and ESGCV projects, they're required to undergo an environmental review process to evaluate environmental impacts. And the analysis includes both how the project can affect the environment and how the environment can affect the project. An environmental review must be performed, and an environmental clearance must be achieved before any funds can be committed to a project. So every project must be in compliance with the NEPA requirements and other related federal and state environmental laws. Every project's environmental impact must be examined, but the extent or the level of review is going to vary depending on the type of activity that is being implemented. So on this slide, we provide a few examples of typical activities that might be implemented utilizing ESG or ESGCV funds. And these are represented on the left-hand side of the table in the blue cells. To the right of those blue cells, we list 4 possible levels of environmental review that you might expect to see with any project that is funded with ESG or ESGCV funds. And those 4 categories are exempt, categorically excluded, not subject to, or commonly referred to as CENST, categorically excluded, subject to, or CEST, and environmental assessment, or an EA. The level of review as it moves from left to right goes from the lowest level of possible impact to the greatest level of possible impact. Generally, the lowest impact levels do not involve construction and can include things such as leasing costs, temporary shelter operations and services, or program administration. Whereas the highest impact levels involved construction such as major rehabilitation of an emergency shelter or even new construction. So depending on the level of review and the resulting impacts, it may also be required that a request for release of funds be submitted as part of the environmental review process, and that you obtain a release of funds, or what is called an authority to use grant funds. It's important that, again, you're documenting your environmental review process. The records should contain the description of all activities that are being carried out as part of the project, and an evaluation of the effects of the project on the human environment and vice versa. A sample list of the types of documents that should be maintained are listed in, again, the green box on the upper right-hand corner, and they include an environmental review checklist for the applicable level of review. So there is a different checklist for every level, every category of review that we just discussed. A notice of intent, if it is required, depending on your level of review and what the impacts are. You may also have to request release of funds. You may need to receive authority to use grant funds. And you should include any remediation verification, again, if that is needed. There are other documents that you will need to maintain depending on the level of review and the activity that you will be undertaking. And these could include things such as tribal consultation. It could include a SHPO review, just to name a few. And so these documents, these records must be maintained in a file, but also these records should be made available for public review should they request to see them. Nora, I will hand it off to you.
I think we're back to me. Thanks, Rudy. We're going to switch from thinking about bigger picture requirements on the program to a little bit smaller and talk about some of the required data that we have to collect on the program and also on the people who are participating in the program. So we've referenced homeless management information systems and comparable databases a couple times. Up to this point, we'll just talk about it a little bit more specifically about what the data behind those acronyms actually is. So grantees and subrecipients have to collect what are referred to as universal data elements and program-specific data elements from each beneficiary. And you can see over on the right-hand side of the slide under the data column, those are the actual requirements which relate to the person, name, social security, date of birth, etc. This data is entered into a homeless management information system, or if an entity is a victim service provider, it may not be entered into HMIS, but is instead entered into what is known as a comparable database, so that information is kept, but it is not shared within the larger HMIS system. And also recognizing the importance of personally identifiable information, there had to be reasonable measures put in place to safeguard personally identifiable information and any other information that is designated as sensitive. So HMIS data is a requirement, and also comes with some established procedures about how to keep that data safe. Next slide. Other data to collect relates not just to the people who are served, but also to the money that is spent, to the actual costs that are incurred. So Rudy referenced 2 CFR 200, which is really the marching orders of all things financial. And 2 CFR requires that any federal expenditure be complete, accurate, allowable, allocable, necessary, and reasonable. So the documentation of costs to show that they are allowable, allocable, necessary, and reasonable is really the data about costs that you're going to be keeping records to support what you've charged to the program. Within California, oh wait, no, not yet, too soon. Within California, there's a specific process that has been established to be able to keep all this information organized, because with a large voucher, a large amount of money that is expended at one time, there can be a lot of data to keep track of and try to keep the necessary records. So the requests for funds, the RFF, is a form that can be used to organize that funding and to be able to keep track of those requests. At the bottom of this slide, there's a visual, in case you're more a visual learner, that just tracks the flow of the money. So what you first would do related to record keeping for expenditures, the first thing you do is you incur the eligible cost, meaning that it is allowable under the ESG regulation, it is spent on an eligible participant, and it is incurred for a cost that is within the scope of what your agreement is. Then there is the ever popular assembling of supporting documentation. I recommend doing that, assembling almost in lockstep with the occurring of the cost. You know, that keeping records becomes a massive undertaking the longer you take to go back and reconcile things. So it's not always possible to have the record right in the moment, but really try to minimize the amount of time between connecting the supporting documentation to the eligible costs that you're going to be requesting reimbursement for. From there, you complete the RFF, and then it is submitted within eCivil. So that is a very, also talk about, 20,000 foot view. This is a very high level overview. There's going to be an entirely separate webinar within this suite of webinars about financial management and walking through that process. But we did just want to touch on it here a little bit to talk a little bit about, because it is so important. There are important records to keep. As you can see over on the side of this slide, there's been a little bit of a list of what some of those records are. The form, the RFF form for personnel costs, those records would be timesheets, payroll, and proof of payment. And then non-personnel costs, you would keep track of the procurement process that you went through, keep track of invoices, and also receipts that you have. Those source documents are very important for monitoring. It is great to have a chart to organize expenses. It is fantastic to have an Excel or another methodology to keep track of expenses, but the actual source document that shows that a charge was incurred and that the cost was paid is really what is going to be looked at to review the allowability, allocability, necessity, and reasonableness of those costs. Now you can go to the next one. With all of that great information that we've received about program participants and also about expenditures, there are reporting requirements to be able to show through the process of all the different layers of this funding, what's being accomplished, who's being served, and what the expenditures are. So this chart walks through those requirements, and it talks about a couple different kinds of reports. One is the Consolidated Annual Performance Evaluation Report, aka the CAPER, which is the annual report that recipients of HUD entitlement funding, which is ESG, which is also the Community Development Block Grant, home funds, and housing opportunities for persons with AIDS, those funds have always had an annual reporting process to HUD. So they still maintain that. Also, there is now a quarterly reporting requirement that goes along with the ESG CV funds. So this chart outlines those reporting requirements, like what's required on a monthly basis, and then what's required on a quarterly basis, and then annually. So if we start at the bottom, we see that subrecipients on a monthly basis are submitting those requests for release of funds to the grantee. So a monthly request helps also not just with cash flow, it helps you to get reimbursed for the expenses that you incurred. It keeps your request size a little bit more manageable because you're not asking for a massive amount of funding all at the same time, which can aid in the amount of time it takes to review those costs. On a quarterly basis at the subrecipient, there is a review and a reporting of that beneficiary, that program participant data in HMIS. There's no special report that needs to be pulled at the subrecipient level. Your responsibility is to enter the data, that client level data, into HMIS. So it's important to make sure that that data is being entered in a timely fashion so that the information about program participants can always be as up to date as possible. On an annual basis, if applicable, subrecipients would submit the report that is necessary that goes along with that Section 3 requirement that Rudy mentioned before. When we go up the next layer within the management stratosphere, grantees are then also submitting a monthly request of funds to HCD. They're also utilizing the HMIS to pull the information about program beneficiary data and pull that and provide it to HCD, and again, reporting on Section 3 if applicable. HCD, for its part, is completing a monthly drawdown of funds from HUD's bank, which is IDIS, the Integrated Disbursement Information System. So they're doing that on a monthly basis, rolling up all of the monthly requests from the layers below. Then on a quarterly basis, they're submitting the ESG CV reports to HUD, which are through a different reporting system known as SAGE. So that submits the HMIS data. That's how they submit the HMIS data about program participants, and also expenditure data. And then on an annual basis, HCD is submitting its consolidated annual performance evaluation report to HUD. So that is the where all of this information is going. It does get used to specifically to be able to show Congress and HUD's other friends about all the great accomplishments and the great continued need for these resources. So reporting is vital for these programs. Next slide. So monitoring is another element of any federal funds, and it is meant to be the process by which there is a verification that eligible program participants are being served with the eligible resources, and that all the program requirements are being met, that programs are achieving their goals, and that really just that the projects are being used consistently with the laws and regulations. This is another area where there's going to be an entirely separate webinar about this specific topic, but we wanted to talk about it briefly because it is so important to the functioning of grant management. So there's a few key, you can break down monitoring into some smaller, more bite-sized, a little bit more manageable elements to think about what monitoring really means. So the first element of monitoring is really assessing risk and planning for how you're going to do your monitoring. There is throughout the federal oversight responsibility, the expectation that monitoring should be based on money and resources that are riskiest. So determining what that risk looks like is a part of a monitoring plan. Often elements of risk include size of resources, how much money there is, also complexity of activities and number and type of activities, or whether or not an entity has received federal funds before. Those are just some examples of what could be included within a monitoring plan. HUD doesn't specify what would be in the plan, other than to say there needs to be a plan and then it needs to be followed. So all of the idea with what we've been talking about with any policy and procedure is that, and the record to support it is that there was a policy in place, and then there were the records in place to show that the policy was followed as it was written down. That's the overarching idea about one of the keys of grant management. So from risk assessment, once you've determined who you're going to monitor, you have to let them know that you're going to monitor them. So there's a notification requirement to say, this is what the, we'll be coming out to monitoring, this is what we will be looking at. That's the preparation phase. Then there's the actual monitoring event. It can occur on site. It also can occur virtually through sharing of records, as long as you're sharing records in through transferring them through email or through other methodologies. There has to be a way to keep people's personally identifiable information safe. So that is always a part of sharing any information. After the monitoring event, the review itself, there's the results. There's the report out of what the results of that monitoring were. So it sounds pretty simple. It probably feels a little scary, but really it is an important element of not just grant management, but good program evaluation. It's a good opportunity to be able to understand really what expenses you're incurring, who you're serving, and just really a good opportunity to touch base to make sure that you've got all the requirements met. The records that are listed here are important elements of a monitoring process, that risk assessment, any communication back and forth about the monitoring. I want to draw your attention to point number 7, which is documentation of corrective actions. So in a monitoring, if there's a violation of a regulation or statute found, that's called a finding. And findings then have a corrective action, which is to say, this is how you resolve that issue. It's important when you're doing a monitoring, if you determine there's a finding and issue a corrective action, that you then also can continue to have the records, or you continue on the process until that corrective action is resolved, and that you have verification that that problem is actually solved, and you keep a record of the entire process from the issuance of the finding to the closing of the finding, because that shows not just that you found it, that you gave the process for how to remedy, but that it actually was remedied. So that's something to draw your attention to within the records about monitoring. Next slide, please. There's the potential monitoring results. There's a few different areas. I just talked a little bit about findings, which you see on this slide, highlighted in red, because those are the ones that are the like, stop, do not continue doing this activity. It is a finding, it's a violation of either the regulation or any of your written standards or agreements. The next layer above that is what's known as a concern, which is not tied specifically to a statute or regulation. It's a practice that is troubling. It is something that if you keep doing it, it is like early onset of a future problem that might lead to a finding. So a concern is raised when there's a situation of something that could result in a finding down the road, or just something that is problematic and the reviewer wants to draw your attention to as something, a practice, an approach, a policy that either should be corrected or that needs to be improved. And if you the results of the finding are in the green, that is that we've gone through monitoring with a clearance, meaning there's no violation of program regulations or the standard written agreements. So What will be reviewed during the monitoring is the elements, the records that are important to have available and handy. Over on the side are those written agreements and programmatic, both programmatic and financial. So we talked earlier about the written standards, which talk through ESG, how it's going to be allocated, who's going to be served, the amount and type of assistance. It's also necessary to have all of your written financial policies and procedures available, and to demonstrate that everyone not just knows where they are, but that they're also part of how your organization functions. You want to have your accomplishments, and then of course, you want to have program accomplishments. You want to have client records related to client eligibility, and if there is any kind of activity related to charging a fee or charging rent to the client, those kinds of calculations. If there's an income necessary, like in homelessness prevention, there's an income requirement, how that income was calculated would be necessary. And then any documentation related to the units, if you're doing rental assistance, so related to determining rent reasonableness, determining that you met those environmental requirements that Rudy mentioned, that will also be a part of the review. And then also the documentation for the costs. So that is really the opportunity to be able to come in and look at the bills, to be able to look at the timesheets, to be able to look at that source documentation that ties specifically to the elements of cost. So that is your infomercial approach to monitoring. Like I said, there will be a more specific drill down webinar in the future. Next slide. Closeout. So we know the ESG money is only for a time limited amount of time. What happens when that time ends is a process called closeout, which is really an administrative process that HUD will either issue separate guidance for, or will use current guidance and just reference it as a way for all grantees. So for HCD to go through the process of making sure that funds are reconciled, that they've submitted all the necessary reports, just that everything is neat and tidy and buttoned up to HUD as it needs to be. This occurs, although we talked about how the funding ends on September 30th, 2020, there is a period of time there where grantees can reconcile funds to HUD. That's generally a 90-day period. So it's not like the bank doesn't shut off on September 30th, 2022. The funds are still available. You just have to be billing for costs that incurred prior to that deadline. But there is a period of time that you'll be able to continue to draw those funds from IDIS. Once a grant is closed out, that does not make it invisible to HUD. That doesn't mean that, oh, the grant's closed now, we don't have to have any responsibilities back to HUD where we can wash our hands of them. No, closeout doesn't impact the ability of HUD to be able to continue to look at costs, to verify that they were eligible, continue to look at records, really continue to just utilize their entire oversight responsibility. That does not end at closeout. Audit requirements don't end necessarily right at closeout. And also, if you still maintain any disposition and property management requirements that were associated with the expenditures, and that also are record retention requirements to still follow even after grant has been closed out. Next slide. And that is it. I'm going to turn it back to Chris to close us out.
Thanks, Nora, and thanks, Rudy. And thank you for attending this California Housing and Community Development training session offered through the Emergency Solutions Grant, Coronavirus Relief Consulting and Staffing Services Contract. Please note that this training session features over a dozen sessions that you can view at your leisure.